From trade wars to kinetic war, the global environment seems to have shifted quite dramatically over the past few weeks.
We are entering into a more volatile phase in global markets and in key commodities like oil. Absolutely no change to our Nifty target. We strongly think that this is a temporary phase for the markets. We are talking about December. So by December, there is very high degree of certainty that this issue will get resolved. Have no doubt that this Iran conflict is far more serious than any other conflict that we've seen recently. However, I still maintain that this is temporary. Okay. Not only are the US and Iran affected, but for example, the rest of the Middle East is getting drawn into this, and they will push back hard against all the players in this conflict, pressurizing them. Even the last oil shock that came to us was during the Russia-Ukraine war, but that was a much lower order of magnitude. The differences here this time is that the closure of the Strait of Hormuz has choked supply of a much larger order. So yes, it is something that will all of this is temporary. We will at some stage get to a point where oil goes back to normalized $60 to $70. Remember that if you take a 20-year view, the demand for oil is structurally falling. Right. And the damage will be far deeper. For every week that the conflict lasts, the damage to the energy market and to India as a country which is heavily dependent on energy imports, probably one of the most among the large major markets in the world, that will be much more severe than anything we've seen in the past. This is global demand destruction. So I've been saying that there is no sector which is completely immune. Just talking about it, India is in a downward spiral where every asset class in India will get battered. Yeah. If the war gets resolved very quickly, and we all know that this is unpredictable, then I would jump straight in. I would forget about the accumulation mode and jump straight in and build a large position in India. India has also is about to strike a deal with the US and has struck a very strong FTA with Europe. Go overweight on India, because I think the next 1 to 2 years is going to be a relatively stronger cycle in India versus the rest of the emerging markets. There will be some damage after the war ends as well, right? Because we are now what I feared the most, that oil infrastructure is starting to get attacked. So in terms of our sector preferences, our top overweight remains
Good day friends, I'm Deepa from the Institutional Equities team and welcome to Macro and Market Moves at Emkay Global. The global environment has turned increasingly uncertain in the recent weeks. The conflict in the Gulf region has pushed crude prices higher. Inflation risks are back in focus and investors across the world are reassessing the growth expectations and market valuation. In fact, many global thinkers believe we may be entering a more volatile phase of the market. Let's take a quick look at what Dalio recently said about the changing global environment.
Look, there's a lot going on in Davos. I know you see everything through the lens of 5 big forces. So money, debt, internal conflict, external conflict, acts of nature and technology, AI. There was so much concern about what the president was going to say here on tariffs. You put everything through capital. Are we living through a big capital war?
We haven't begun the capital war yet, and I think that draw attention to it. I don't even think people think capital war. They hear a lot about trade war. And how does a capital war work, and what is happening today pertaining to the markets and so on? Okay, the big issue is the opposite side of a trade imbalance is a capital imbalance. And so we have an issue now with the changing complexion of what is owned by capital. Right. So central banks buying gold and replacing bonds and other assets. We see these things happening, the changes in that mix. And so President Trump's speech was very, very important because there's a line, a red line, that has to do with military as it pertains to Greenland. And if there is a military move, it has capital war implications. But beyond that, the issue of what is held as a reserve currency and the whole capital issue is something that's extremely important, not paid much attention to, and not understood.
Joining me today is Seshadri Sen, Head of Research and Strategist at Emkay Global. Seshadri brings in over 3 decades of experience in equity research across both sell and buy side, with nearly 2 decades tracking the BFSI sector at leading global houses. Currently, he heads research at Emkay with a team of over 50 plus research analysts and associates, tracking the breadth of the market across 22 sectors. With a close eye on over 200 plus stocks, he strategizes our model portfolio and publishes his India strategy report for global allocators assigning capital in the Indian markets. Welcome, Seshadri.
Thank you.
Seshadri, from trade wars to kinetic war, the global environment seems to have shifted quite dramatically over the past few weeks. We now have an active conflict in terms of the war going on in the Gulf region. Crude prices are moving sharply higher and renewed uncertainty around inflation and growth. From a strategist's perspective, does this feel like a temporary shock, or are we entering a structurally more volatile phase of global markets across the regions?
I'll answer it in reverse. We are entering into a more volatile phase in global markets and in key commodities like oil. Have no doubt that this Iran conflict is far more serious than any other conflict that we've seen recently. Even the last oil shock that came to us was during the Russia-Ukraine war, but that was a much lower order of magnitude. The differences here this time is that the closure of the Strait of Hormuz has choked supply of a much larger order, and it is leading to shortages globally as well.
Yes.
Secondly, it is also leading to supply chain disruptions across many other sectors.
Yes.
I will not dismiss this as saying this is just another passing conflict. This has far more deeper global ramifications than anything we've seen in the last 5 to 7 years. However, I still maintain that this is temporary.
Okay.
I don't think that it is in anybody's interest to extend this and risk this much of disruption to the global economy. Not only are the US and Iran affected, but for example, the rest of the Middle East is getting drawn into this, and they will push back hard against all the players in this conflict, pressurizing them to bring it. So yes, it is something that will all of this is temporary. We will at some stage get to a point where oil goes back to normalized $60 to $70. Remember that if you take a 20-year view, the demand for oil is structurally falling.
Right.
But this may last for a little longer than everybody anticipated initially, and the damage will be far deeper. For every week that the conflict lasts, the damage to the energy market and to India as a country which is heavily dependent on energy imports, probably one of the most among the large major markets in the world, that will be much more severe than anything we've seen in the past.
So as per you don't think that it's kind of a sustained energy shocks, but it is material enough to really make big dampening impacts into the economy? Can you just sum up a few consequences for this in India, and how would it really impact various sectors?
So as we put in a chart in our latest report, which breaks it up into the key impact zones, so to say. There are 4. The first is demand destruction. Right? And this is global demand destruction. So I've been saying that there is no sector which is completely immune. So one of the top performing sectors has been IT, which I agree with.
Yeah.
But even IT will face demand destruction because this will lead to a global slowdown and possibly a US recession.
And slowing in the IT allocation
IT budgets will slow down, etc. So no sector is immune. Demand destruction is the first.
Yeah.
In India, it will be more material in terms of, at some stage the government will have to pass this on to pump prices, and there'll be an immediate impact on demand.
Sure.
Not only for autos, but also remember that there's a large pool of especially two-wheeler owners for whom the demand for fuel is inelastic. If you are commuting to work every day, you can't stop commuting to work. So that extra cost impinges on other consumption. So there is, cross elasticity of demand, which will lead to fairly widespread demand destruction. So that is the first. The second is raw material cost rise. As we all know, oil is at the core of plenty of raw materials. The entire plastics universe is dependent. Some of it will get acutely impacted because India is diverting refinery production towards LPG. That will send the price of some plastics soaring.
Right.
So you will see a lot of unintended consequences which will have raw material impact, inflation. The third is supply chain disruption, which is most acutely felt in the LPG space, right? And even I discovered in the last 2-3 weeks that there are plenty of sectors which are actually dependent on gas, which you didn't think it would, right?
Yeah.
Meaning the car assembly paint shops dependent on gas. If gas supply stops, it is like a lifeline flowing through the economy. If that chokes up, where and what slows down is very difficult to anticipate, but there will be an impact.
It was quite widespread, could be spiral,
and
immediately gauging the extent would be difficult. The problem is that if it lasts too long, then it could be becoming.
It will, and as plant, shutting a plant down and restarting it has its own costs and damage. So that is the third, which is the supply chain disruption. And in general, the fourth is energy availability. So this will cascade. I was speaking to a corporate the other day, and they were saying that we have nothing to do with the entire oil supply chain, but by the way, coal prices are going up, right? So you may not have anything to do with it, but there will be, so any sector which is overall energy costs in the country will start going up in the short term. So, these are the four pillars on which I am analyzing, how sectors will get impacted. Demand destruction, supply chain disruption, raw material inflation, and energy inflation.
Let's try to look at from a more global and a more macro perspective again. Like major investors like Dalio talking about that the way the world is changing, the geopolitical conflicts which are rising, high debt levels across the global markets, structural shift in global orders, and this war is kind of validating all those things. As a market strategist, in your point of view, do you think the investors are really underestimating the shifts which are happening in the overall global market environment and the geopolitical?
I think I'll again answer it in two parts. If you leave the geopolitics aside, the rest of the global shift that are actually been overemphasized by investors. And I'll take one example of the AI trade, for example. We've had a 1.5 year run of AI trade. India has been punished because it is seen to be either neutral or negative in terms of the AI trade. We don't agree that AI will wipe out the Indian tech sector, but some do. But even if you don't, India is at least neutral. I mean, India has no benefits from the AI trade as well. Whereas, and the market's taken that trade to the extreme, right? So I don't think that investors have ignored major structural shifts they have overbought into what the biggest structural shift that is happening in the global economy, which is
actually explains the underperformance of the past.
Part of the reason why India has underperformed. There are other reasons as well. Geopolitics, I think, has, on the other hand, I partly agree that geopolitics has not been fully captured. But that is very difficult to do because the entire geopolitical scenario is the underlying truths have not changed, right? The world hasn't, the Middle East is still important. 5 years ago, the narrative was that, oil is dead and, the Middle East doesn't matter anymore, etc. That narrative has come crashing down at this point in time. Yes, you would not have conceived of maybe this kind of a conflict where the entire Middle East is drawn into a battle.
Right.
But if you said that it was inconceivable that US and Iran would go to war one day, that also I think you always knew that there was a possibility on that front. So the short answer is that I think a lot of these geopolitical shifts that are being talked about are temporary. There is one factor which also I think has been quite strongly discounted in the global markets, which is probably the declining importance, I'm choosing my words carefully here, of the US and the US dollar. But that has manifested itself in the gold price, and I would I would think that if anything there could be a shift back to normality on that trade.
Yeah.
But that is the other. So looking through all the noise, there is one big geopolitical change that is happening is the declining strength of the US dollar in the global economy. But I would say two things to it. One, a large part of it is discounted and look out for gold prices there. And two, I think that, to some extent, the obituary of the US dollar is being prematurely written.
Yeah.
The reality is...
just sorry to interrupt you there, but are we talking about since we are talking about US dollar and the importance of it in the global perspective and already the gold, the way it has played out, do you think that we are again into a commodity super cycle kind of a scenario with dollar's relevance going out and this is not just...
Yeah, commodity super cycle is, I don't think that we are in a commodity super cycle. Every time the narrative of a commodity super cycle comes up, it's usually the peak of the commodity trade. I remember the words being used before the GFC. You need two things for a commodity super cycle, which have nothing to do with the US dollar. One, you need very low interest rates because that's when financial investments pour into commodities.
Right.
And two, you need very strong global demand. Right?
Yeah.
None of that is happening. In fact, you're probably at peak global demand. Yeah, you could see in a falling interest rate scenario globally, but I don't think anybody will pump the kind of liquidity that central banks did up to say 5-7 years ago.
Yes.
We are in a long-term structural trend where global liquidity is on the wane. It is not on the rise. So I don't think there is any situation set for a commodity super cycle. I will differentiate between commodities and gold, right?
Okay.
Commodities, maybe the odd commodity because of renewable energy, of EVs, copper or the odd rare earths may see a super cycle.
Right.
But that's not a commodity super cycle.
But you remain bullish on gold, seeing what your opinion on dollar.
So gold is, at the moment, gold looks like in a strong position. The US has probably the last few weeks have, if anything, undermined the US dollar much more.
Yeah.
But I think US will also revert to mean over the next 10 years. Right? This administration has probably overplayed its hand in terms of we'll do what we think is right kind of situation. And there are two factors behind the decline of the US dollar. One is their trade policies, the other is now this kind of aggression. I think if you take a 5 to 7 year view, it is more likely that the US will revert to mean on this front. And while the gold trade may continue, if I was a 5-year investor, I would still, and though I'm a little biased on this, stick to equities.
Stick to equities. Yes, great.
Equities,
Okay. Let me bring back the discussion more towards India and seeing the impact of all the geopolitics which is happening. So you did mention that you don't think they should last too long because many parties are involved and it's not in favor of anybody at this point of time. But supposedly, hypothetically, it lasts much longer than we think so, and the oil prices remain high. Let's evaluate the situation in the domestic economy. There is supply, we get supply but at a price. In that scenario, how do you see the India earning growth evolving over the next 1 year? And since in last 6 months we have been in a positive liquidity environment, both aided by the government and the central bank, how does it change for the next 1 year?
No, so India is in a negative spiral, downward spiral if oil stays at $100 for say 6 months. Not likely that will happen, but just talking about it, India is in a downward spiral where every asset class in India will get battered. Let's look at it, let's get the easy one out of the way. Currency obviously will be under intense pressure. Our latest note talks about the possibility of 95 to the dollar. That's because not only does India's import will rise, exports will also slow down because
but do you think that will change the stance of the central bank drastically here and move into a tightening phase rather than
unlikely? So yeah, the dollar and then remittances. So central bank will not tighten. I think they will not raise rates unless because they will also see this as a passing phase. However, in defending the rupee, they may have to tighten liquidity willy-nilly because when you go and defend the rupee, you tighten. They try to now do it through forwards, which is postponing the problem to some extent. But ultimately, it does have an impact, and we've seen, in the last 1 year, that periods when the RBI steps in to defend the rupee, it has an impact on domestic interest rates. But so you may see a situation where the RBI policy rates are not being raised, but market rates, both bond yields and bank lending rates, start to inch up because of the domestic liquidity situation.
And it again debases the theory of the earnings revival and pushes it ahead.
Correct. So, and then your earnings revival, as if you look at the Nifty is actually a little more immune because about 60-70% of the Nifty, if you look at financial services is 35%, the consumer FMCG, which I don't think will face an incremental pressure from rising input prices, or IT. There are there are few sectors which are relatively untouched, which add up to maybe 60-70% of the Nifty, but the broader market will see. So there are many other sectors which will see intense pressure. We are already seeing corporates saying we are very cautious, but come April, May, we may have to do plant closures, or we may have to take. You've seen auto companies, I think CV companies have already started price hikes. So the summary is that I think you will see, at the Nifty level, probably 3 to 4% earnings. But if you go deeper down, then you could see a 6 to 7% earnings hit coming. And remember, we are entering the third, we've already seen 2 successive years of very low earnings growth. So another third year of shock will send we see a possibility of a 10% downside to the markets.
Okay, so let's come back to India in that matter, that as a global allocator, as a global strategist, India still is an expensive market compared to other emerging markets. And with all these geopolitical disruptions, the uncertainty of revival of earnings, or there could be a pushback in that, how would you allocate your funds into the emerging market portfolio, and especially India?
I think this is a great point at which to look at India with respect to the rest of the emerging markets. India's valuation premium has shrunk considerably because of the re-rating that happened because of AI, many of the other. Remember, AI is an earnings-less trade, right? Meaning AI is all hope, and there are considerable doubts about the ultimate profitability in AI. Because of the massive investments needed upfront. So the valuation gap has considerably closed. Remember, India, as I was alluding to earlier, it wasn't just AI. India was also in a down cycle since FY24, when ahead of the elections, India entered into a tightening mode, which was to preserve stability, which is always a good thing. Meaning, you're always prudent to, if it's necessary, sacrifice growth for stability. But now that is done, and India is now in an upcycle. India is in a mode of simultaneous stimulus on both the fiscal and monetary side. So India is set for an upcycle in FY27, which has been disrupted by the Iran war, but it will happen. It will manifest itself. If we get a resolution, it will be a very quick bounce. We've already seen a lot of naysayers who were proved wrong, because the auto cycle has lasted longer than most people initially thought. So you got three things going for India at this point in time. One is that the valuation premium has shrunk. Two, that India is on an upcycle in terms of the broader economy, and that is manifesting itself into earnings. And three, ownership of India is relatively low. I think globally there is a severe under ownership of India.
So it just in the earnings cycles
it needs a little bit of a spark to set that to turn that reverse. However, as we were discussing a little earlier, the Iran problem is a very real and material problem, and India is one of the countries which is most affected, because we are heavy. It is a very heavily dependent on energy imports, and there is a very large pool of overseas workers, and their remittances to India is also a very vital component in India's current account and external account balances. So India is at risk, which is why it may take some time to recover. So if I was a global allocator, I would start nibbling at India, use this correction to slowly build up an opportunity, but with the warning that if the war lasts long, this may continue to be an underperforming market for a little while. But that is, we are at the last legs of the India underperformance cycle. And once the war is resolved, it will very quickly. If the war gets resolved very quickly, and we all know that this is unpredictable, then I would jump straight in. I would forget about the accumulation mode and jump straight in and build a large position in India, go overweight on India, because I think the next 1 to 2 years is going to be in a relatively stronger cycle in India versus the rest of the emerging markets. Remember, we are also at this point in time where the US is set for a slowdown. Many of the emerging markets are actually heavily dependent on exports to the US. And India has also struck, is about to strike a deal with the US and has struck a very strong FTA with Europe. So over the next 3 years, those will also manifest themselves in earnings which are not yet discounted in the price. So I think we are set for a very strong 3 year. This is a good time to allocate back into India. Only thing is that, while the Iran war is on, just nibble at it till you get certainty that the war is about to end.
Because oil is a very important factor.
It is a very important factor.
Yes. So let's come back to your Nifty targets. In the last discussion, you suggested that you see Nifty somewhere around 29,000 for the calendar year 26. How do you view your targets on Nifty now? And what would be your preferred sectors in the market?
Absolutely no change to our Nifty target. We strongly think that this is a temporary phase for the markets, we are talking about December. So by December, there is very high degree of certainty that this issue will get resolved.
Sure.
And by, whatever, there will be some damage after the war ends as well, right?
Right.
Because, we are now, what I feared the most, that oil infrastructure is starting to get attacked in the Middle East. But all of that will get resolved. Oil will go back to being 60, 70, or may undershoot as well to 50. And then the India's natural momentum will take over.
Right.
So we see no reason to meddle with our year-end Nifty target at this point in time.
Sure.
We'll see if the first quarter leads to major earnings downgrades, then we may relook at it, because it's an earnings and valuation combination. But at the moment, we see very little risk to that Nifty target.
Sure.
Remember, our Nifty target is based on the CY, the year 27 earnings, right? None of which is going to get impacted by this. So, no change at all.
Single biggest risk is now the external, that when this geopolitical unrest gets resolved and how it gets resolved. Right?
So, in terms of our sector preferences, our top overweight remains consumer discretionary. We think that the stimuluses that the government has given is going to trigger a long duration consumption cycle in India. So consumer discretionary remains our top overweight in the overall sector. Industrials also remain strong, because I think India's capex cycle is strong and will intensify as we go along. And third is so these are our two top overweight sectors at this point. While we remain underweight in financials, we think there's a selective tactical opportunity in that sector, because it's been beaten down a little too much.
Right.
And we do not buy into this extreme view on technology. We think this is a good time to look at the Indian technology sector. Some of the AI fears have been overplayed, and valuations are now very attractive.
Sure. Seshadri, thank you for your insights in such a volatile environment. This was quite informative, and I'm sure that the investors would get a direction to where to play the Indian markets now.
Thank you so much.
For the investors, the challenge today is not just tracking short-term market moves, but understanding how global developments, whether it is a conflict in the Gulf region, inflation risks, or changing growth expectations, could influence the allocation decisions, sectoral performances, and earning trends going forward. India continues to remain an important market for institutional investor. But as you pointed out, staying disciplined on valuations, keeping an eye on macros, and being selective at the sector level will be critical in navigating the financial year. Thank you for joining us and sharing your perspective. And thank you to all our viewers for tuning into Macro and Market Moves. We will continue to bring you conversations that connect the global picture with Indian market opportunities. Until next time, happy investing.